back to the Pentonomics program, the real alternative to the fatuous financial media. It's my great pleasure to welcome John Tamny to the program, and I'll read you his bio. His bio is very long. This guy is all over the place. He is the political and economic editor at Forbes. He's the editor of Real Clear Markets, and he's a regular guest on that Saturday morning bonanza called Forbes on Fox. If that wasn't enough, he wrote a book called Who Needs the Fed? Who Needs the Fed? This is a great book. I've read it, and it's a wonderful read. And the conclusion to this book is that, and something we both agree on, is that who needs the Fed? I mean, it's completely unnecessary. And I believe the Fed is very pernicious to a vibrant middle class and in the long run for robust economic growth. So welcome again, John Tamny. And tell us a little bit about why the Fed is completely obsolete and actually deadly to real growth.
Well, I think it's obsolete because you have to look around the real economy. The conceit is that the Fed can make credit easy. Well, I say look at Hollywood. Brian Grazer has one of the greatest track records in the history of the industry. We're talking Splash, Parenthood, Beautiful Mind, television shows like Arrested Development and 24. But as he freely acknowledges, even though he's got this amazing track record, his attempts to attain credit to fund his ideas fail the majority of the time, over 90%. You look at Silicon Valley, it's commonly assumed that credit's easy out there. If you have a good startup idea, money sources will be the path to your door. But as we see out there, credit's incredibly expensive. If you to fund your idea, you'll give up a big portion of the business to a venture capitalist, even more to lure potential employees. Investment bankers are paid very well precisely because credit is incredibly difficult to get for all but the biggest of businesses. And I look at here, Michael Milken, his fortune was a function of the fact that the vast majority of banks that the Fed deals with don't touch the average business. He invented the high yield bond and transformed commerce. I look at our president, Donald Trump. He had a great track record until he didn't in the early 90s, and banks started to shut him off substantially. And so my broad point is, while the Fed's over here decreeing easy access to something, in the real economy, we act as though the Fed doesn't exist. And I think that's a very healthy signal that the Fed's just not that important.
Okay, so the Fed's not that important, but you wouldn't call them irrelevant, would you? And the reason why I say that is because the Fed controls something very important called the base money supply, basically physical currency and central bank credit. So if you remove the Fed, I assume that you espouse base money to be a function of gold mining supply, physical supply of gold and silver, maybe even silver. So you have that mine supply growing about 1.5%, 2% per year per annum in terms of gold. Is that how you would control the base money supply?
In my perfect world, if the U.S. Treasury is going to remain as the mouthpiece for the dollar, I would say, why not peg the dollar to the price of gold and then let the supply of dollars be a function of that peg. And so if let's just say it's at $1,000 an ounce, if it rises to 1,001, that's a sign that there are too many dollars in the system. Pull back. If it goes down to 199, it's a sign that the economic system's growing. It wants more money to lubricate actual economic activity. My sense is that over time, private money is gradually going to replace this. I'm not an activist about it. I just think that's probably where we're headed. But where I would quibble a little is that I don't think the Fed controls the money supply. Let's look at a city like Baltimore. What if the Fed started buying up treasuries from Baltimore banks to increase the supply of money there? That supply would vanish instantaneously. And it would, because banks can't stay in business lending to those who lack the means to pay it back. Conversely, you could keep money supply out of Palo Alto on your best day. The Fed could sell bonds to bank en masse in Palo Alto to, quote, shrink the money supply, and global sources of money, which can be exchanged for real resources, would immediately fill in. So this notion that the Fed can increase or decrease the money supply is, I think, defied by basic on-the-ground realities.
So just to be specific, though, I was talking about the base money supply, so that's physical currency and central bank credit. I think what we're both saying is the Fed cannot really control the demand for money, which leads to the broader aggregates, M1, M2, and M3. So you can flood the banking system with reserves, but where does the demand come to borrow that money? And if the consumer is in a situation of debt saturation, which I believe they're very close to being in, then the demand for money isn't there. And that money, that credit, lays fallow in the central bank system. Is that correct?
Yeah, well, as an example, let's look at quantitative easing. The Fed thought, okay, if we borrow 4 trillion from certain banks, their excess, and start buying up securities, banks will start lending. But in fact, what we saw, and this was logical, the U.S. economy did not rate that increase in the supply of money, and so those dollars rapidly flowed out of the United States, much in the way that they would flow out of Baltimore or some other impoverished place. Production is the source of money. Now, my argument is the Fed can't increase credit. We create credit. When you borrow dollars, you're not borrowing the dollars to stare at them. I'm preaching to the choir here. You're borrowing access to trucks, tractors, computers, desks, chairs. Only the private economy can create credit. What the Fed can do is create dollars that are exchangeable for those real resources. But in terms of pushing them into the economy to stimulate it, it can do no such thing. If there's production, there will always be money in abundance. If the Treasury vaporized the dollar tomorrow, there'd still be lots of money supply in Beverly Hills and Greenwich and Palo Alto because there's production there. Where there isn't, the Fed can't change that reality.
Well, let's talk about what the Fed did after the credit crisis circa 2008, 2009, is they went out and expanded all this credit by fiat out of thin air. And what did they do? They bought mortgage-backed securities and treasuries, which artificially suppressed the cost of borrowing money. And when you do that, you can create a huge bubble in fixed income, and that interest rate, the price of money, is a key indicator for everything else, every other price, every other asset price in an economy. And not only that, by taking interest rates down to record lows, and 20% of the world's sovereign debt market has a minus sign in front of it, you would also encourage a lot of new debt. You look at auto loans and student loans and credit cards. In fact, household debt today stands in nominal terms at an all-time record high. So talk a little bit about, yes, the Fed cannot control broad money supply or the overall money supply. They cannot affect the demand for money, demand for credit, but they do a lot of warping and distortion in asset prices. Can you talk a little bit about that, please?
Yeah, I would probably quibble with that. For one, again, where was the easy credit? It's certainly not easy in Silicon Valley, certainly not in Hollywood. If you look back to when oil prices declined in 2014, suddenly borrowing in Texas, which had been much easier, suddenly became very difficult. And so my argument is that no matter what the Fed does, in the real economy, credit costs are far more related to the market. In terms of asset prices, I don't buy the correlation, and my example would be Japan. Figure that the BOJ has foisted no less than 11 QEs on its economy since 1989, pushed interest rates down. Where was the stock market rally? We didn't see it. My argument is that the Fed had nothing to do with the stock market rally. If it did, the argument was, well, the Fed has pushed interest rates so low that there was a rush into higher yielding securities. But if so, logic dictates that there would have been a big correction in bonds and low yielding bonds to reflect this rotation out of them. We never saw it. I go back to Japan again. I ask what happened in the early 2000s when the Fed cut rates substantially. Where was the stock market rally? But the bigger thing I would say is that if you believe the Fed was the source of the rally, what you must then conclude is that the Fed robbed us of what would have been a much bigger asset rally, because markets, like economies, gain strength from periods of weakness. That's how we starve poorly run businesses of resources and direct them to their highest use. So if in fact the Fed was propping up the stock market, which I think Japan disproves, if that's true, logic dictates that a lot of really good businesses did not receive credit as the Fed propped up yesterday. That would scare away investors more than anything.
Okay, so let's talk about the Fed's, and in fact the globe's, obsession with a 2% inflation target. I kind of laughed. I kind of chuckle about this whole notion that an economy can't function well unless there's at least 2% inflation. So the value of your purchasing power of the currency has to depreciate at 2% every year. Otherwise, it's the economy will be in a state of havoc. What do you think caused them to obsess so much about 2% inflation? And what is it about 2% that's such a magic number? As if we had 0% inflation and robust GDP growth, we'd have a huge problem on our hands.
Oh, there's so much wrong with the Fed theorizing. Let's begin with the basic truth that economic growth is the biggest enemy of rising prices mankind has ever known, because when economic growth presumes investment, investment drives down the price of anything. The mobile phones we have today used to cost $4,000 and they're brick size. Flat screen TVs used to cost $25,000. Now we can get them for a few $100s. Computers used to cost $1 million. Now you can get them for next to nothing. And so, in fact, it's the economic growth that drives down prices. But as I think you might agree, the Fed's definition of inflation is not how you and I define it. You and I define inflation as a devaluation of the currency. The Fed defines it as economic growth driving up prices. But in fact, as we know, economic growth brings down prices. Furthermore, it mitigates labor shortages, because what is economic growth? It's computers, it's Wi-Fi, it's airplanes, it's cars, constant labor-saving devices that destroy old forms of work in favor of new ones. And so, in fact, if you want to have abundant labor supply, you want abundant economic growth. That's what frees up labor for new ideas. So the Fed has a problem of definition. Even if its belief in a 2% inflation target, if that were based on devaluation, it would be incorrect, because it would be a disincentive to saving. Savings drive the economy upward. But the Fed believes economic growth causes inflation, which shows the further utter confusion of the people inside there.
Right. As if, Henry Ford and the Model T, it was a huge example of how productivity is how you grow an economy. So you have labor force plus productivity. I never saw the equation of inflation enter into the question. And in fact, as you get a populace that believes that the value of their currency is falling, that hurts savings, that eliminates and attenuates the demand for borrowing and real productivity. So let's turn to, I'm very interested, because I think you're a very smart guy. I want to talk about Donald Trump. And I really don't know where you stand on Donald Trump. I voted for the man because I'm a libertarian. And I thought that Hillary Clinton would be much worse than Donald Trump, and I still think that she would have been. But let's talk about candidate Trump versus President Trump. So candidate Trump hated the Fed. Now he kind of likes Janet Yellen. Candidate Trump liked a very strong dollar. Now he's a espouser of a very weak dollar. He liked interest rates to go higher. Now he wants interest rates lower. The stock market was a signal of a huge bubble. Now it's kind of a proxy and a vote of the confidence that we have in Donald Trump. And I could go on and on about NAFTA and China as a currency manipulator, and now we're good friends with China. So where do you stand on President Trump versus candidate Trump?
Well, I'll answer your question backwards. As President Trump, I am a crazy libertarian. So President Trump, oddly, I like, and let me explain.
Sure.
He's not getting anything done. Beautiful. There's your stock market rally. He can't do anything. He had all these big ideas. He is distracted. I love distracted presidents who can't accomplish much in the way of legislation. Wow, thumbs up. Candidate Trump terrified me, because free trade is the sole reason that we work. We want to get in return for all of our work. You have the whole world competing to serve your needs. Even better, free trade is what enables us to do the work we do best. When we can import from others, whether across the street from around the world, we can focus on the work we do best, and it's beautiful. I would add that the candidate Trump regularly talked about how I heard him constantly saying that Japan and China were succeeding because they were devaluing their currencies. That's incorrect. In fact, he got it wrong throughout history. But I heard him saying that he wanted a much weaker dollar. He disliked the Fed. I don't think he knew why he disliked the Fed. I kept hearing him say that a weak dollar was good for the country. He's 100% incorrect there. And so I kind of like even what he's become there. He's made a few comments. I don't want the dollar to get too strong, but he's not making the comments, at least that I can find, that I want a much weaker dollar. So even there, notice the gold price, it started to correct upward. Trump versus Clinton, they both wanted protectionism, and the dollar corrected upward. It weakened. It seems that the dollar, there's maybe a little bit of a relief rally. Gold hasn't continued to rise, which I think even there, someone in his administration has told him that presidents get the dollar they want. That's true. I say it's in the book. I point out it's not the Fed getting the dollar. Presidents get the dollar they want. And Trump's maybe quieter about it. My fingers crossed.
So is Janet Yellen going to be reappointed in February, or are we going to get Gary Cohn? Who do you think should? Well, we both think that nobody should replace Janet Yellen. They should just bolt the door and blow up the building. I say that figuratively, of course. But who do you think, is there going to be a replacement for Janet Yellen? And if so, who do you think that is?
Well, I'll answer that backwards too. I'm probably preaching to the choir, but I think it needs to be made clear that why would you have a Fed in the first place? Let's look at what it does. It was made a lender of last resort in 1913 to solvent banks. Let's be clear, if you were solvent, you could go to the Fed for a loan, but as we've seen, that's unheard of. If you're a well-run bank, you never go to the Fed. It's an admission of bankruptcy. Okay, so it serves no purpose there. It can only be there to prop up insolvent banks, weakens the system. The Fed is a bank regulator. Oh dear, if you're working at the Fed, you probably couldn't get a job at the bank. They can't police the people who are more talented than they are. We don't need the Fed for that. Targeting a rate at which banks lend to one another overnight, please. There's no need for the Fed. We're not going to get rid of it, but what's the purpose of it? Janet Yellen, I'd actually written a column back not long after she was nominated saying that it could be a bullish sign because Ben Bernanke had so discredited the Fed and QE that she wasn't going to be able to do much. And so I like that she's a non-factor. I like Fed chairman or the non-factors because I think they can do damage. So if he reappoints her, is she clueless about economics? Would we destroy her in a discussion? Yes, we both would. But I don't think she's able to achieve much. Barring Janet Yellen, my choice would be David Malpass because I think like we do, he feels that the Fed should be much less relevant. Cohn scares me. He lusts for the job. That is so dangerous.
What do you think? Well, okay, so Gary Cohn gets in. Trump gets his own man in there. What do you think he does? Is there going to be a trenchant change between what Janet Yellen? Is it going to be a quicker removal of the unwinding of its balance sheet? Will they truncate the unwinding of the balance sheet? What do you think happens with Chair Cohn?
You're closer to the markets than I am, but I almost think it's irrelevant. I think whatever happens it's been priced, and I don't see the big deal. Banks don't need the Fed to attain dollar credit. They can sell their assets to all manner of institutions to attain more lendable dollars. And so if the Fed starts selling securities back to banks, okay, it doesn't strike me as the end of the world, but would Cohn do more of it? I somehow doubt it. But I also think it really doesn't matter. What scares me is what would Cohn do if he got into trouble again, if a Goldman got into trouble again. I love Wall Street, which is precisely why I bailouts of banks and investment banks. That scares me. Let's be clear. From my days at Goldman, Henry Paulson hated bailouts until he was for them. I worried that Cohn would be a captive of his past.
Okay, so what I'm really hearing, the book is fantastic, and I encourage everybody to read it. So what I'm hearing from you and from reading the book is that the Fed or central banks in general, are pretty much irrelevant. Just want you to touch on this, please. So if you look what happened in 2012, when Mario Draghi uttered his ukase, we will do whatever it takes to bring down borrowing costs. You see, Greek 2-year note was, I think it was as high as 200%. The Italian 10-year was flirting with 8%. And then you see in Europe, rates are down. The German Bund is now about 50 basis points. Look over in Japan, which is an insolvent retirement nation. They have a 250% debt to GDP. They have, again, a 2% inflation target, which is, this miracle. 2%, and yet their 10-year note is 0%. So what would happen, and I think we can agree that central banks, if they were to step away, rates would rise, but that would be a very good economy in the long run, because if you agree with me, John, I'm very interested to hear, this could probably end up being the last question, unfortunately, that's part of the healing process. Recessions, depressions, they're a cathartic, cleansing, healing process that brings down debt levels and asset prices to a sustainable level. And we could start again from scratch with a viable economy and stable currencies and stable tax rates and stable inflation. So tell me, what do you think would happen? Because it looks like right now, the direction the Fed and the ECB and maybe even the BOJ, that's where they're headed. They're trying to remove this stimulus. What happens to rates and what happens to economic growth on a global basis?
Well, I first want to add to your point that yes, recessions, painful as they are beautiful. They're the sign of an economy fixing itself, cleansing itself of the bad habits, the badnesses that no longer make sense. That's why they lead to booms when they're untouched. I say same about markets. They gain some periods of weakness. That's how you starve the bad in favor of the good. I still question the idea. Mario Draghi can decree whatever price of credit he wants. But if you're a business in Greece and you want to expand, good luck getting this easy credit. It doesn't exist. There's no such thing. In the real economy, the Fed doesn't exist. And I think that, and central banks in general don't exist. And I think that's crucial. In terms of where this goes, I say again that the global economy continues to work around what makes no sense. The Fed is often never Neverland, and we can talk about the Fed funds rate at 0.50 and it's lower in different places. Is that the Fed or is that the banks leading the Fed? Banks are so strangled right now. They're so overregulated. How could they take in and pay for deposits when they're not allowed to take any big risks in the first place? Let's reduce this to the absurd. Let's say the Fed raises its target to 3%. Can suddenly Bank of America pay 3% for deposits? Lots of luck there. They're so overregulated, it couldn't do it in the first place. And so I think we overrate the Fed's role in the cost of credit overall. It's okay, government bonds are very expensive right now. Well, yeah, I suppose when government bonds are backed by the most productive people on earth, and I think the Japanese, we underrate their economic success. We underrate, yeah, of course, governments can borrow cheaply. I just wonder how much the Fed has anything to do with that.
Well, I'll tell you, I hate to end this interview because I have so many questions. I would love to hear your thoughts on the stock market as it's relative to GDP at 135% of the economy, and if you think that's sustainable. You have just one final quick thought on the stock market?
I say again, I think the stock market would have been higher had the Fed done nothing. I reject the notion that the Fed could trick doing something that you and I both know is plainly bad for the economy, stimulating government spending and buying up mortgages, which was basically trying to retain what had already failed. Why would the smartest markets in the world be fooled by something that was plainly so inimical to economic growth? It didn't work in Japan. Why would the smartest markets in the world be cheered by the Fed theoretically propping up marginal businesses? Logic, exact opposite would have taken place. I don't buy that the Fed is nearly as powerful as people assume. Markets are rather smart. If the Fed could prop up in the U.S., could have done in Japan, didn't work.
I keep wanting to continue this interview, and I just don't want to let you go. I want to leave with this one. I promise to be the absolute last question. Prediction from John Tamny: are we going to get tax cuts? Or are we going to get tax reform? I prefer that you lower the tax rate for both individuals and pass-throughs and corporations, but I want the government shrink. I want there to be a reduction in spending. So I want a prediction from John Tamny real quick. Do we get tax cuts or do we get tax reform?
Well,
when?
Government spending to me is the biggest tax because it takes away from the private economy. The supply siders have missed this in a big way. I don't think we're going to get tax cuts we like. Everything that I hear says that they're giving in on tax cuts for the highest earners, which they have the greatest ability to stimulate the economy because they've got wealth to invest. I'm hearing more and more that it's going to be rather slim what they're pursuing. It amazes me. But what I will say to leave you with a bit of optimism, I'll go back to it. You show me a president who's not legislating, I'll show you a favorite president of mine. I will take a president getting nothing done over a good tax cut that then would be followed by protectionist legislation and massive government spending. If Trump can be distracted, you're looking at a happy person right now.
Oh, what a great guest. Once again, John Tamny, Who Needs the Fed? And if you haven't got yourself a copy of this book, go out and get yourself a copy and read it. Really good job. Thank you so much for being my guest today, and hopefully you'll come back in the near future.
Michael, anytime. Thank you so much for having me.